What if I told you that the biggest financial scam in history isn't hidden in the past? It isn't a dusty Ponzi scheme exposed decades ago. It isn't just the name of a disgraced financier like Bernie Madoff. It's still running, right now, out in the open. And most people participate in it every single day, not because they're foolish, but because they were never shown how the system actually works. This isn't about conspiracy theories, it's about incentives. It's about power. And it's about a financial structure so deeply embedded in modern life that questioning it feels almost absurd. But once you see the pattern, the cause, the effect, the repetition, you can't unsee it. Tonight, we're going to unpack what may be the biggest financial scam in history and why it never seems to end. Welcome to Its Financial History too. Let's start at the beginning. For most of human history, money was tangible. Gold, silver, land, something scarce, something difficult to create. Then came banks. At first, banks were simple storage houses. You deposited your gold, and they gave you a receipt. That receipt could be traded. Convenient, efficient. But here's where the twist begins. Banks realized something crucial. Not everyone would come back to withdraw their gold at the same time. So they started lending out more receipts than they had gold. This practice became known as fractional reserve banking, and just like that, money could be created out of thin air. At first, this system expanded slowly. Then industrialization accelerated it. Governments needed funds for wars. Businesses needed capital for expansion. Banks created credit. Economies grew. It seemed like magic. But here's the hidden mechanic. Every new dollar created was born as debt, not as wealth, as debt. And debt has to be repaid with interest. Now pause and think about that. If every dollar in circulation is created as debt and interest is owed on top of that, where does the extra money come from? It has to be created too, which means more debt, which means more interest, which means the system must expand forever. Or collapse. This is where the story intensifies. In 1913, the United States created the Federal Reserve. Similar central banking systems existed in Europe, but this move formalized a powerful shift. Money creation was centralized and institutionalized. After World War II, the Bretton Woods system pegged global currencies to the US dollar, and the dollar to gold. That system held, until it didn't. In 1971, President Richard Nixon ended the gold standard. From that moment forward, the world entered the era of pure fiat currency. Money backed not by gold, but by trust and government decree. Now money could be created without physical limits. And it was governments borrowed, central banks printed, credit expanded, asset prices rose, stocks climbed, real estate boomed, consumption exploded. At first, it felt like prosperity. But cause and effect were quietly building beneath the surface. When money is created faster than real productivity grows, purchasing power declines. Inflation. When credit is easy, people borrow more than they should. Bubbles. When bubbles burst, the system trembles. And that's when we hit the breaking point. In 2008, the global financial system nearly collapsed. Banks had issued mountains of mortgage-backed securities based on risky loans. Housing prices had been rising for years. Everyone believed it would continue. Until it didn't. When homeowners defaulted, the securities collapsed. Banks froze, credit markets seized. The world stared into the abyss. And here's the moment that defines the scam. Instead of allowing the institutions that created the crisis to fail, governments stepped in. Trillions of dollars were created. Bailouts, quantitative easing, emergency liquidity. The system was saved. But saved for whom? Homeowners lost houses. Workers lost jobs. Savings evaporated. Yet major financial institutions survived and eventually thrived. This established a dangerous precedent. Profits are private, losses are socialized. If you win, you keep it. If you lose, taxpayers absorb it. And here's the repeating pattern. After 2008, interest rates dropped to near zero. Cheap money flooded markets. Stocks reached record highs. Corporate debt surged. Student loans ballooned. Government deficits widened. Then came 2020. During the pandemic, governments around the world injected unprecedented liquidity into the system. Stimulus checks, business support, emergency lending. In the United States alone, trillions were added to the money supply in months. Asset prices skyrocketed. But so did inflation. Food prices climbed, energy costs rose, rent increased. And once again, the burden fell disproportionately on ordinary citizens, while asset holders benefited from inflated markets. This is where the scam reveals itself more clearly. The system depends on constant expansion of debt. Expansion benefits those closest to money creation first: banks, governments, large corporations, asset owners. By the time money reaches the average worker, prices have already risen. This is known as the Cantillon effect, though few people ever hear the term. It explains why wealth inequality keeps widening even during economic growth, because the growth is uneven by design. Now let's connect the modern parallels. Global debt has surpassed $300 trillion. That's more than 3 times global GDP. Interest payments alone consume massive portions of government budgets. Central banks attempt to fight inflation by raising interest rates, but higher rates make debt more expensive to service. So they face a dilemma: raise rates and risk recession, lower rates and risk inflation. Either way, the system strains, and yet it continues. Because stopping would mean acknowledging that infinite growth on a finite planet is mathematically unstable. Here's the psychological twist: most people don't feel scammed. They feel squeezed. They feel like they're running faster but getting nowhere. Wages struggle to keep pace with living costs. Housing feels unattainable. Retirement feels uncertain. But the structure producing those outcomes remains unquestioned. Why? Because it's normalized. We're told this is just how the economy works. But step back. A system where money is created as debt, where expansion is mandatory, where crises are resolved by creating more of the same fuel that caused them, where those closest to the source benefit most. Isn't that at least structurally similar to a perpetual cycle that transfers wealth upward? Now here's the delayed answer to the opening question. Is it a scam in the legal sense? No, it's legal, institutionalized, codified. But structurally, it behaves like a system that requires new participants, new borrowers, new taxpayers to sustain promises made in the past. And when growth slows, pressure builds. That's why pensions become underfunded. That's why governments inflate away debt. That's why currencies historically lose purchasing power over time. This isn't about villains in secret rooms. It's about incentives embedded in monetary architecture. And until incentives change, patterns repeat. Let's end with 3 clear takeaways. First, understand how money is created. If you don't understand that most money begins as debt, you can't understand inflation, bubbles, or inequality. Second, follow incentives, not headlines. When crises happen, ask who benefits from the solution. Bailouts, stimulus, rate cuts, they all redistribute value in specific directions. Third, protect yourself through awareness and diversification. Assets that hold value. Skills that remain in demand. Reduced reliance on debt. These are defensive strategies in a system built on expansion. Here's the warning. No monetary system in history has lasted forever. Empires change. Currencies shift. Structures evolve, often during periods of instability. The question isn't whether this system will face stress again. It's when. And when that moment comes, will you recognize the pattern? Or will it feel like a random crisis? Another headline, another emergency, another unexpected downturn. The biggest financial scam in history may not be a single event. It may be a repeating cycle. A cycle powered by debt, sustained by belief, and stabilized by intervention, until it can't be. If this video challenged how you see money, hit subscribe. Because understanding financial history isn't about fear. It's about clarity. And clarity is power.